we're starting to see the early kind of traction for that economic slowdown. Now, that doesn't necessarily mean a recession just yet, but we should start seeing slower rates of economic growth. Now, the important thing about that is that earnings estimates for companies are extremely elevated. So if we see slower economic growth, that is going to start to bring down those earnings estimates. In this environment, we're likely going to have to see prices adjust lower as we get into next year to accommodate for valuations. But here's what you need to know before the bell this morning. After this last 8 trading sessions, which have been actually pretty brutal for the markets, again, not outside of the realm of normality by any stretch of the imagination. And again, back in June and July, we were talking about this need for a 3 to 5 to a 10% correction, still very much within the context of that kind of normal corrective action that happens in any given year for the markets, particularly after you've had a market that has rallied basically 15% in the first half of the year, having a bit of a pullback. Not surprising. If we go back to the last 3 years, we've had seasonal weakness in September of 3 to 4%, and in both cases, or sorry, all 3 previous cases, that led to a fairly strong end to the fourth quarter, and that was even during 2022 during the bear market. Of course, the market bottomed in October and we rallied into December. So again, that kind of seasonal pattern of summer weakness leads to basically a potential for a rally into the fourth quarter. So again, that's still what I would be expecting, and for a couple of reasons for that is, as we talked about the last couple of days, first of all, the MACD sell indicator is still intact here for certain, but we're getting fairly oversold. In fact, we haven't been quite this oversold in the markets in quite a while, and most of these more oversold conditions, you will note, correspond with rallies in the markets. And again, we go back and every one of the previous short-term bottoms, and again, we're just talking about short-term bottoms, that's all, is that when markets get this oversold, you're generally going to get a reflexive rally. Now, what kind of rally you're talking about? Well, right now, a rally back to around 4430 on the S&P would certainly be logical. That would come up, retest this 50-day moving average. We've got the 20-day moving average sitting right below it right now. There's certainly some resistance at 4370, where you have the 100-day moving average. But again, a reflexive rally back to retest some of these previous kind of ranges for the market would not be surprising in the short term. And that'll certainly be a good opportunity to kind of rebalance the portfolio, kind of reevaluate risk. Think about what, kind of how you're positioned and what you're looking for potentially heading into year end. And interestingly enough, this still remains a market that is driven by 7 stocks for the most part. In fact, if you look at the market return this year so far, the market right now, as of yesterday's close, is up a little bit over 11% for the year. So still, even with this correction, it's been a very good year for the stock market. Well, it's been a very good year for 7 stocks in the market, because if you look at the equal weight index, it is actually now flat for the year. So if you've owned any other stocks outside of that, market performance hasn't been great this year. Portfolio performance hasn't been great. And this is one of the other reasons that potentially sets this market up for a rally over the last couple of months of the year, is portfolio managers need to play catch up with whatever moves next in the market. So we're going to see some positioning trying to play catch up with market returns this year as we start to get ready to close out the year. That's what you need to know before the bell this morning.